Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello from the land of recovery. Knee surgery, not drugs, that is. This is Charlie Jewett with episode 102, and this is entitled Why I Never Use Whole Life Insurance. Now, this came up recently with some important clients, but really it's been a part of my life for the last 14 years, because as soon as I got into this industry, I heard all the different tools that existed and tried to figure out the right place to use all of them. Where to use this one? Where to use that one? Try not to have any biases, which is a huge problem in this industry. But whole life insurance, I've never, ever found a place where it does a better job than any of the other tools. Now, it's not on purpose. Remember, I'm the guy that doesn't hate any tools. I'm the one that says, wait a minute, never talk bad about a screwdriver because it doesn't drive nails in, or stop yelling at your hammer because it doesn't, screw in screws. Tools are just tools. They're neutral. Anybody who says, I hate blank and you should too, or comes out strongly against a tool or says, I'd rather die and go to hell than put somebody into blankety blankety blank, you know that they're being an absolute selfish buffoon. That kind of language exposes the immorality in someone's heart, and you know that they're going to try to steer you into what's best for them and worse for you, because tools are neutral. However, if a tool has no place, if there's no way, if you have to hurt someone to use a tool, you have to keep them from using something better to get them to use a certain tool, there's just no reason to use it. I'm still not going to talk bad about whole life insurance. I'm just going to tell you why I don't use it, why I think there's better alternatives, and how you can do that, okay? I thought it was a little bit funny. I went to create this episode and realized I accidentally skipped 91. Not sure what kind of pain medications I was on back then, but I didn't do an episode 91. It jumps from 90 to 92, so sorry about that. I'm so sorry. Anyway, life goes on. I guess that means my episode 100, that I thought was episode 101, because there's an episode 000, is actually episode 100 after all. Anyway, I'm sure that was as clear as mud. Let's jump into it. What is my issue with whole life insurance, and why don't I use it? Well, first and foremost, when I was probably 3 or 4 years into the business, I worked for a marketing organization where there were about 6,000 of us life insurance agents. I was in the top 15. I was a real big wig back then, a big wig. Top 15 of 6,000 agents. And one time I asked the leader of the organization, I said, hey buddy, you know more about insurance than I maybe will ever know. When is whole life appropriate? Where do you use whole life where it does a better job than anything else? And he said, Charlie, I have to be honest with you. Universal Life was created to fix the weaknesses and problems that the E.F. Hutton organization found with whole life. And he said, I don't ever use whole life. I can't find anywhere where it does a better job than anything else. Now, I would never just take someone's word and go, okay, I'll never even study again. I went and studied it myself and frankly found the same conclusion. I can always get a universal life insurance contract that I tweak and change. And maybe that's the difference. Maybe it's because people don't know how to build whole life or build universal life insurance contracts that they look at whole life or get duped by the false guarantees or whatever it is. I shouldn't say false, I should say unnecessary guarantees. However, even somebody with 6,000 insurance agents told me, he says, I can't find a place for whole life either. So let's jump into some of these reasons. Now, the number one most influential piece of this to me is the low rate of returns. Now, I do not want to ever listen to a whole life salesman. They're some of the best salesmen in the world, evil geniuses. If you can sell something that only makes 3.5 and convince people that it makes 8 and do that over and over, decade after decade after decade, while people are getting those returns, you're doing a pretty good job. You're just doing something that's wrong. But I think the people that work for the whole life organizations are incredible salespeople. I just don't respect what they're doing.
Hey, why would I sell calculators or computers when I get paid to sell abacuses, abaci, abaconundrum? This is what I get paid to do.
But if you want the real truth, don't listen to a salesman. Go to third-party research or third-party data. So let's do this together. Right now I'm going to go to Google and put in Instagram. And then I'll just do it the way you would. Instagram, Charlie. And I'm just going to tell you to put .Jewett because there's a dot in there for some reason. Or if you just search Charlie Jewett, that's Jewett, Instagram. Eventually, you're going to find this, this URL, www.instagram.com/charlie.jewett/blah, blah, barf. There's a bunch of stuff in there. Get to my Instagram page or do it on your phone, and you'll find some pictures of my dog, some Christmas pictures. Hey, I am a person. And then there's also financial information that's useful for you. The most recent thing I've posted, and this is December 23rd, almost Christmas time. It's beginning to look a lot like Christmas. Actually, not here in San Diego or Hawaii. It looks a lot like Baywatch. But if you go here and you open up this file that I've attached here, it's called Actual and Illustrated Participating Whole Life Historical Performance. This matters more to me than what any goofy salesman says, because it's actually going to show you on this piece of paper what the salesman used to sell policies and then what those same policies actually paid the policyholder 20 years later. Now, how many companies are we looking at? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. The last one's repeated twice for some reason, 2 different policies. But, 12 different companies. There's some big names in there. You're going to recognize them. And, we didn't look at every single product ever sold on Earth. It's just a selection, okay? So where I want you to go is over to total cash value. So it's on the right-hand side, bottom of the page. We're not looking at 10-year performance. We're looking at 20-year historical performance, so 1990 to 2010. And under the section called Values with Paid-Up Additions, kind of on the left side of that section says Total Cash Value. And you'll see Illustrated IRR or Illust IRR and Actual IRR. Well, first, what is IRR? IRR is internal rate of return, meaning what do you keep? What's the rate of return internally after all of the expenses? It's kind of like saying net rent. If you have a rental property and they're paying you $2,000 a month, you're not making $2,000 a month. You're making $2,000 a month minus any expenses like mortgage, insurance, repairs, vacancies, things like that, taxes. What are you netting, right? So the internal rate of return that was illustrated at the point of sale to show why the consumer should buy this whole life. If you look at it, 7.36, 6.88, 5.94, almost nothing under 6%. The two that are in the fives are barely under 6%. So basically, the whole life guys are saying, you can make 6 to 7% with my Whiz Bang Whole Life product. Huh? Hey, you want one? Going quick, going fast, buy it today. Everyone's doing it. Peer pressure. But what do they actually pay? If you look 2 columns to the right, it'll say actual IRR. Could there be anything more important in any investment than what it has actually paid? You guys know that's my issue with the joker brokers in the stock market and basically the entire financial services industry, is that they're illustrating the returns of the stock market based on a lie, based on faulty math. Well, I shouldn't say it's faulty math. It's actually, they're giving you the mean. If a market goes down 50% and up 50%, you're making 0. That's what they say, because negative 50 plus positive 50 divided by 2 is 0. The problem is that's not the way money works. It's never the way money works, and they know it. If 100 grand goes down 50%, you have 50. If it goes up 50%, you have 75. So a 0% rate of return means you're actually negative 25% because these guys are so smart and went to school and got a bunch of degrees, so they were better at lying at you. My problem with the industry is that actual rates of return are not reported. Well, this is actual rates of return from third-party company who doesn't care about any of these. They're impartial, unbiased. They're looking at 12 different insurance companies from their whole life and saying, dudes, you guys said that people were going to make 6 or 7% on your illustrations. Looking back after 20 years, people made about 3.5 to 4. There's one that illustrated 6.6 and it made 5.11. That's closer. We're still talking 1.5% less compound interest for 20 years, which is huge. But most of them are showing returns of about half of what they promised. And let's be even more basic than that. Most of them are you're just compounding money at 3 or 4%, which it's not going to grow that fast, okay? So my biggest issue for sure is very basic, which is the proof that it grows well, that it can compete with the stock market or compete with other, other compounding tools is just not there. Particularly for an insurance product where you should be making 6 or 7% after your fees. I just don't like the returns. So go to Instagram and take a look at that and see why. My second problem is the dividends. So inside of a whole life policy, you're a policy holder. You kind of own a piece of the company or whatever. And at the end of the year, they say, oh my goodness, how much should we share? We made a bunch of profits. How much should we share with the people that own these policies? It's subjective. It's just one company deciding. There's a board of directors sitting around smoking cigars or whatever going, how much do we want to pay these guys? How much do we want to keep for ourselves? One company's profits or one company's profitability, how they do that year, and then a bunch of people deciding subjectively how much to share in dividends. I don't want my retirement or investments staked on that kind of a subjective situation. It was part of the entire reason that universal life was created, to separate the returns from the company. So if you take a basic indexed universal life policy where they say, okay, if the S&P 500 goes up, you get the first 12.5. If it goes down, you get nothing, but you don't lose anything. Well, what's S&P 500 mean? Well, it's the top 500 most widely traded companies in the United States. It represents like 70% of the entire stock market, those 500 companies. To talk about diversified versus non-diversified, whole life year returns are not even close to being diversified. One company, subjective. Indexed universal life, 500 companies that can change over time, because it's going to be the top 500 companies. You're capturing about 70% of the movement in the market or what's going on, and it's diversified across those, period. It's separated. Your returns are unbiased. They're independent of the company that sells you the policy. You don't need your life insurance company to remain profitable. We just need the top 500. Really, all we need is for human beings who buy stocks, bonds, and mutual funds to continue to be emotional, to continue to be driven by fear and greed, which is what drives the market up and down anyway. In index products, you just need bouncing. You need volatility. We need years where it goes down so that you don't make any money, but you don't lose any money, but it resets at a nice new low and creates a very, very high probability for the next year or the next couple of years to be up years where you make the first 12.5%, which we'll talk a little bit more about in a minute. The other issue I have with whole life is unnecessary guarantees. Wait a minute! Sound the alarm! How could a guarantee ever be unnecessary? Well, it depends on how much somebody charges you for it and what we're guaranteeing against. You've probably heard me say, I do not carry flying cow insurance. Why? Because I've never had a cow fly through my roof or fly through my car, or I've never seen a cow fly in any other way except for maybe in the movie Twister, where I think a cow was caught up in a tornado and flew around, and I thought it was really funny. But other than that, I don't need flying cow insurance. I'm not going to guard against something that's never happened. Well, inside of whole life, if you look at the illustration, it basically says if you pay your premiums but never make any money, you never lapse. You never run out. You're still making something. You're making 1% or 1.5% or 2% or whatever the silly guarantee is. So they're basically guaranteeing against making nothing and having the policy lapse, having the cost of insurance eat up all the cash value. You're basically guaranteeing against something that's never happened, and I would argue is probably not possible for it to happen. Why do I say that? Well, if you give up this guarantee that comes inside the whole life policy, and you go over to an indexed universal life insurance policy, if you look at the guaranteed column, or what's the worst case scenario, if the S&P 500 goes down every single year relative to the previous year, so it goes from 26,000 right now, 2,600 down to 2,500. Next year, 2,400. Next year, 2,300. Then it goes down to 18. Then it goes down to 15. Then it goes down to 13. Nobody in the big mutual funds, Warren Buffett, George Soros, nobody with money ever says, wow, that's cheap. Begins to put money back into the market by purchasing, which drives the price up. That never happens. The market only goes straight down for the rest of your life. Remember, in 67 years, the market's only gone down 2 years in a row, maybe 2 or 3 times. It went down 3 years in a row one time in the early 2000s. We're talking about it going down every single year for the rest of your life. It took from 1950 to 1974 before it even went down 2 years in a row. And then it took to the early 2000s from 1974 before it ever did it again. But what we're talking about is the market going down every single year for the rest of your life. If that happened, yes, your indexed universal life insurance policy would lapse. Now, you'd have to be stupid and in a coma to not do anything about it and let it lapse, because obviously if the market went down 5, 6, 7, 8 years in a row for the first time, we're probably going to 1035 exchange your policy. We're going to move it. We're going to refinance it to a different company or just cancel the bugger and just get out of it, okay? So we're protecting against something that not only can't happen based on historical performance, and really more importantly, I would say it can't happen based on what the market really moves based on, which is fear and greed of human beings. At some point, the market gets cheap. People are going to say that's cheap and they're going to buy it, and that's going to drive it back up. But those guarantees, why do I say they're unnecessary guarantees? Not just because they're guaranteeing against something that hasn't happened, like flying cow insurance, but what they're costing you is ridiculous. I mean, if you look at the returns on Instagram they're about 3.5% to 4%. Let's just call it 4%. If you're using this, you're putting $1,000 a month away to an insurance strategy to create tax-free distributions during retirement. Can't call it income, but it's distributions you use to pay your bills. Are you happy, compliance? Don't choke on your fettuccine now. It's not income. It's just money that you take out of a place that's yours and you use it to spend on stuff. It just sounds like income, but it's not income. It's distributions you use to pay your bills. If you're putting $1,000 a month away at 4% for 30 years, it ends up around $700,000. If you can make 6%, same money, $1,000 a month, put it away same time, but you're making 6%, you end up with over $1 million. It's like 43% more money. 43% more money over 30 years if you're making 6 instead of 4. So why in the world would I give up 43% of my money to make 4% in whole life to have guarantees that aren't even necessary? It just doesn't make any sense. Fourth point, historical returns, dividends, unnecessary guarantees. I don't like whole life for those reasons. Fourth point is flexibility. Universal life isn't even really called universal life. It's called flexible premium adjustable life insurance. What a mouthful. Flexible premium adjustable life insurance here. Anybody want some? Anybody want some? No, we call it universal life because it's universally applicable to so many situations. Why? Because it has a flexible premium and adjustable what? Death benefit. You sign up for whole life and you don't pay that premium, you're done. You can't lower the premium. Sign up for an index universal life policy where it's max funded. You can change a lot about the premium. You can change the death benefit in a couple of years and drop it in half. There's a lot of flexibility, not 100% flexibility, but a whole lot. I've had people do $20,000 a month to policies and say, what if I have a rough month? And I look at the minimum and says, well, it says you can drop it to $2,300 $2,300 a month instead of $20,000. That's a lot of flexibility to be able to pay between $2,300 and $20,000 plus. Once you pay the $20,000 for the first couple of years or whatever you're paying, you have some cash value where you could probably take a break and not pay premiums for 6 months to 3 years or whatever it is. So flexibility to make changes after you sign up is another reason that I use universal life insurance instead of whole life. And I didn't write this on my notes, but the fifth point, if you go look at my video or podcast called The 6 Ways to Improve Your Cash Value Life Insurance, is my most important tool is wiping away 75% to 80% of the commissions to the agent. That's me. Ding, ding, ding. Why would I want to make less money? I don't want to make less money. I'm a fiduciary. It's my job to do what's best for you. This is why I sound arrogant. I'm not. I'm just right. But I sound arrogant because I'll challenge anybody in the country and say, you will not beat me. You cannot beat me. You're not man or woman enough to beat me. You're too arrogant and greedy to beat me. You could go learn the same things that I learned. But once you get to the point where it says you have to make 20% of the commission that everybody else makes, you're going to go into your immoral heart and say, well, I can't do that. That's not fair to me. I got to rip people off and make the money I deserve. That's how I know I'm going to beat you. It's not just arrogance. It's 1, nobody's ever beat me in 14 years. 2, I can't find anybody unless I've trained them who's willing to be humble and do what's right for the client and make the appropriate amount of money for us and just make it up in referrals and volume. Other than that, I don't have any strong opinions on the subject. Hey. So, whole life, my issue with whole life is that I am a believer in tools. I carried a tool belt as an electrician, and I had tools that were really, really good at 1 or 2 things, and that's all they did. So I had 9 to 12 tools on my tool belt and then a van full of tools. Whole life, in my opinion, tries to do way too many things. Like, it's got some guarantees, it's got some returns, it's got some tax benefits, it's tax-free, on the growth if you build it the right way. It's got some death benefit, and it's not doing any of them well. It's not doing any of them. Why not just have 4 or 5 tools that do each of those things better than whole life, than have whole life that does all of them poorly? Now, if you're a whole life salesman and you can show me how to beat a universal life insurance policy, truly, how it can do better than universal life built the right way, I'll put you on the show. I don't have any problem. I don't have any arrogance inside of me. I love the truth, period. I will stand up on the show. I don't know why I'd be standing on the microphone. I will get on the microphone. I'll put you on the show and say, here's a guy who showed me something I've never seen before, and I want you guys all to know it. So get in touch. Charlie@JewettWealth.com. CHARLIE at JEWETTWealth.com. Plus, if you just bought a life insurance policy or you're currently shopping for any type of cash value life insurance, I don't care if you want death benefit or if you want to grow your cash. Either way, doesn't matter. I can beat every single policy in the country right now, and until somebody beats me, I'm not going to stop saying that. So if you're shopping for life insurance, let my team show you and hold that other advisor accountable. We've done it over and over and over and over again, save people tons of money or put extra money in their pocket at no cost by just eliminating the expenses inside the policy. Just get in touch. Charlie@JewettWealth.com. CHARLIE at JEWETTWealth.com. Or you can just go to JewettWealth.com and read all of our stuff and watch all of our videos and listen to all the podcasts. Okay, so why would I use Index Universal Life instead of Whole Life? Well, higher returns, lower fees, more flexibility, same exact strong companies as the Whole Life. Sounds like a winner chicken dinner to me. You people are the best.
Let me just add an addendum here after the episode about what's called infinite banking or be your own banker, the bank on yourself concept. This is what I want to say. The books written in that world, the concept of stick all your money inside of life insurance, use the favorable terms to borrow from yourself instead of borrowing from credit cards or cars, things like that, borrowing back against your policy to pay things like down payments on real estate, to purchase the 5 to 7 cars you might own in your life. All of that is completely sound. The books are incredibly well written. I love the book, Bank on Yourself. Be Your Own Banker is a little older. He gives maybe one paragraph to Universal Life, which I think is kind of silly. But that concept is phenomenal. And really, if you listen to me on the real estate podcast that I get interviewed on, I'm teaching real estate investors why to never store equity inside of homes, use the least of their own money as possible, keep all of their money inside of life insurance, borrow against their policy to make down payments. Really, what that all adds up to is you have a second mortgage to 100% financing, without qualifying for it at incredibly favorable terms and no payments ever due, not due till you're dead. It's absolutely awesome. However, I do want to give you a warning or a disclosure. I don't know what it is, but every single teacher or author in the Be Your Own Banker or Bank on Yourself world seems addicted to Whole Life. I've never seen a Whole Life illustration that I couldn't beat the pants off of instantly with 5 minutes of work. So I don't know what it is. Any of those people, including Pamela Yellen, you're welcome to be on the show and have a debate with me. So far, no one will debate me. I don't know why. I'm here. I'm ready. All I care about is the truth, and I want to help people. I don't know what you're afraid of. But just a little warning, if you end up reading Be Your Own Banker or Bank on Yourself, or you get into the infinite banking world, which I recommend, I think it's an incredible world, you are going to end up in a whole life sales machine that has incredibly high pressure, and the pitch is amazing. Here's the easy way to take care of it, which is what some clients just did. Just get the illustrations. Get the illustrations. They say, tell them, show me your best. What should I do? They're going to give you the illustrations and just send them over to my team. Send them to me, Charlie@JewettWealth.com, CHARLIE at JEWETTWealth.com, and let us just run an apples to apples comparison. There is no way you're not going to see the difference. It's going to show up. If you have an extra 20, 30, 40% returns in the product outside of Whole Life, you're going to see it right away. I just did this for someone. So be your own banker, bank on yourself, infinite banking. That concept is phenomenal, but you're going to end up in a very hardcore sales pitch for Whole Life. Make it simple. It's not about the salesman. Nobody buys anything because of the salesman. You make sure you get what's best for you. Send it on over to my team, and we'll do an apples-to-apples comparison. Charlie@JewettWealth.com, CHARLIE at JEWETTWealth.com. Happy holidays, guys.
Renovating retirement with Charlie Jewett.
But that's all, folks.